Brad Williams, Frugal Finance. How about hedging an equity portfolio? Hedging stock. Stock index futures are used to hedge a highly diversified equity portfolio. Define P, current value of the portfolio. F, current value of one futures contract. The futures price times the contract size. The portfolio mirrors the index. The optimal hedge ratio, H, equals 1. In equation 3.3 from telling the hedge, N equals H V of A V of F, shows that the number of futures contracts that should be shorted is N equals P divided by F. So without dwelling into Finance 101, let's just continue, and I'm assuming you have a basic idea of what hedging is, that you know what an equity portfolio is. You're familiar with the S&P. If not, let me know. I will put together some fundamental courses that explain all this stuff. So let's say that a portfolio worth 5.05 million mirrors the S&P. Today, we probably could throw 3 zeros on that because 5 million is nothing. 5 billion, maybe. But let's say we're dealing with the S&P 500. The index price is 1,010. And that just shows you how dated this information is, because what did we hit? 5,700 yesterday? And each futures contract is on 250 times the index. In this case, P is equal to 5.05 million and F is equal to 1,010 times 250 equals 252,500. So that 20 contracts should be shorted to hedge the portfolio. You see that? You just divide 5 divided by 2.5 and this should equal 20. When the portfolio does not exactly mirror the index, we can use the parameter beta from the CAPM. If you don't know what CAPM is, let me know and I'll explain it. I'm not going to do that now. The CAPM to determine the appropriate hedge ratio. Beta is the slope of the best fit line obtained when excess returns on the portfolio over the risk-free rate is regressed against the excess return of the market on the portfolio over the risk-free rate. If that sounds foreign to you, again, that's just CAPM language, where beta is equal to 1. The return on the portfolio tends to mirror the return on the market. When beta is 2, the excess return on the portfolio tends to be twice as great as the excess return on the market. When B is 0.5, it tends to be half as great, and so on. A portfolio with a beta of 2 is twice as sensitive to market movements as a portfolio with a beta of 1. So it is essential to use twice as many future contracts to hedge the portfolio. Equally, a portfolio with a beta of 0.5 is half as sensitive to market movements as a portfolio with a beta of 1. And we should use half as many contracts to hedge it. In general, H equals beta, so that equation 3.3 gives beta, N is equal to beta times P of F. So this formula presumes that the futures contract maturity is close to the maturity of the hedge. We illustrate that this formula gives good results by extending our early example. Suppose that a futures contract with 4 months to maturity is used to hedge the value of the portfolio over the next 3 months in the following situation. We have the value of the S&P at 1,000. We have the value of S&P futures at 1,010. Value portfolio 5,050. Risk-free rate 4%. Dividend 1%. Beta portfolio 1.5. Our future contract is for delivery of 250 times the index. It follows that F is equal to 250 times 1,010 equals 252 from equation 3.5. The number of future contracts that should be shorted to hedge the portfolio is 1.5 times 505 divided by 252. I know I'm just shortcutting some of these numbers for obvious reasons. It's just easier for me to shortcut it. Assume the index turns out to be 900, ouch, just a big haircut, in 3 months, and the futures price is 902. The short-term gain from the short's future position is 30 times 1010 minus 902 times 250 equals 810. The loss on the index is 10%. Actually, it's more than that. The index pays a dividend of 1% per annum. or 0.25% per 3 months. When dividends are taken into account, an investor in the index would therefore earn negative 9.75 in the 3-month period. Because the portfolio has a beta of 1.5, the capital asset pricing model gives expected return on portfolio equal minus expected return minus risk-free rate equals 1.5 times return on index minus risk-free interest rate. The risk-free interest rate is approximately 1% for 3 months. It follows that the expected return on the portfolio during the 3 months, when the 3-month return on the index is negative 9.75, is 1 plus 1.5 times negative 9.7 minus 1 is equal to negative 15%. Wow. All right. So the expected return is very bearish. The expected value of the portfolio at the end of the 3 months is therefore 4.28 million. It follows that the expected value of the hedge position, including the gain on the hedge, is 4.2 plus 810 equals 5096187. Table 3.4 summarizes these calculations jointly with related calculations for other values. That is just a bunch of number crunching. Nothing difficult there. It's just understanding the taxonomy. I just thought I'd throw that word in there. You need to follow the structure of hedging, equities, CAPM, beta, risk-free rate, dividend, all standard stuff. Much easier than when you're looking at the fixed income arena. Value of index, you can see 900, 950, 1000, etc. Okay. If you're shorting, clearly this is to your advantage. And then when you're long, you're going to see it's a net if you've hedged correctly. In other words, if you follow these rules, on average, they're correct, and you're hedging based on CAPM beta requirement, then these numbers are probably fairly accurate. If you're hedged, it's going to be a net neutral, and you might make some money. But if you weren't hedged, you just have to look at the alternative. Again, as a portfolio manager, you need to understand why you're hedging. You're going to lose your job if you don't, or if there's a threshold as to what risk level the portfolio can absorb. Way off topic, so I'm going to get to the end here. Brad Williams, Frugal Finance, brief introduction to hedging.